Welcome to This Explainer. We're diving straight into the long-term blueprint of a true retail juggernaut, Costco. If you're focused on long-term corporate strategy, you really need to pay attention to this 2026 trajectory. We're going to unpack exactly how Costco is evolving its foundational profit engines, executing massive digital improvements, and pushing into high-density urban real estate to unlock totally new markets. Let's get right into it. Here is our roadmap for today. 1. The executive profit engine. 2. Driving digital transformation. 3. Unlocking the urban frontier. And 4. Strategic reinvestment for growth. Section 1. The executive profit engine, the foundation of future growth. Okay, consider this absolute powerhouse of a statistic. 74.3%. Out of roughly 82 million paid household members, about 39.7 million are executive members, so less than half the base, right? But they generate nearly 3/4 of all net sales worldwide. These are your true power shoppers. They treat Costco as the absolute center of their household spending, which gives the company an incredibly predictable and resilient revenue base. And that loyalty translates directly into pure, predictable profit. Membership fee income just surged 13.6% to hit $1.36 billion for the quarter. Now, sure, about a third of that bump came from the September 2024 fee hike, but underlying organic growth was still a rock-solid 7.5%. But the real magic, the actual strategic moat here, is their 92.1% retention rate in the US and Canada. Even when prices go up, members simply don't leave. So how exactly do they keep these executive members so incredibly sticky? Well, they've curated this tight ecosystem of perks. We're talking an increased 2% cash back, now capped at $1,250 a year, add in a $10 monthly Instacart credit and exclusive early shopping hours. It creates this brilliant behavioral loop. Members consolidate their shopping to max out their cash back, which literally pays for the membership itself, driving up lifetime value and insane warehouse volumes. Section 2. Driving digital transformation, enhancing throughput. Right now, we're seeing a massive acceleration in omni-channel engagement. Total comparable sales saw a very healthy 7.4% bump, but digitally enabled sales, they skyrocketed by 22.6%. Digital is absolutely no longer a secondary channel or some afterthought for the warehouse club. It is a primary engine now. We're talking a 32% jump in site traffic and a 45% spike in app usage. People are engaging online more than ever before. And honestly, that digital surge wasn't an accident. Costco is aggressively rolling out AI-driven personalized product carousels, and it is paying off big time. They converted digital browsing into over $470 million in measurable e-commerce revenue growth in just one single quarter. By putting the right high-margin items in front of the exact right members at the right time, their tech modernization is delivering massive dividends. Now let's talk about the physical warehouse, because technology is transforming that member experience too. They are completely revamping the checkout flow to maximize throughput. Imagine integrating mobile wallets, pharmacy pay-ahead features, employee pre-scan tech, and automated pay stations. The result? An 8-second average transaction time. Let me say that again, 8 seconds. It essentially eliminates the biggest point of friction in the store and turns a painful bottleneck into a completely seamless exit. And speeding up that transaction is an absolute operational necessity. Fresh foods alone saw low double-digit growth this quarter. When you are moving that kind of massive volume, optimizing your throughput is literally the only way to scale. 8-second checkouts mean that heavy foot traffic turns directly into revenue per square foot, rather than just generating long, frustrating lines that could threaten that 92% retention rate. Section 3. Unlocking the urban frontier. High-density expansion. Costco wants to open 30-plus new warehouses globally every year, but that brings up a huge spatial dilemma. Highly lucrative, densely populated urban markets just don't have the real estate for a massive traditional footprint. So the big strategic question is, how on earth does a standard 25-acre warehouse model survive, let alone thrive, in the middle of a dense urban center? The answer is a pretty dramatic real estate shift. They are pivoting away from relying entirely on those sprawling, single-level suburban lots. Instead, we're seeing a major push into creative, high-density, mixed-use infrastructure. Think multi-story facilities, structured parking decks, and get this, even residential units built right on top of the active warehouse. This new urban model is exactly how they unlock deeply constrained, massive value markets like LA and New York. CEO Ron Vakris actually hit the nail on the head here. He stated, "We are not changing the model, but we are being a little more creative with the use of things like parking decks, residents above our locations." By stepping into the role of a sophisticated urban developer, Costco's leadership guarantees that a lack of physical real estate simply won't cap their global market penetration. Section 4. Strategic Reinvestment for Growth, the Flywheel Effect. To truly understand the mechanics of Costco, you have to look at a metric called the core-on-core margin. Basically, this is the gross margin on core merchandise, stripping out gas and other noise to show true underlying profitability. Now, despite aggressively lowering prices, their core-on-core margins actually grew by 22 basis points this quarter. That's a huge deal. It definitively proves that their efficiency gains across tech and the supply chain are completely outpacing any margin compression. So what do they do with those expanded margins? They hand them right back to the customer. Costco acts as a ruthless, uncompromising pricing authority. They reinvest those operational savings right into lower commodity prices. Kirkland's signature butter dropped from $13.89 to $8.49. Olive oil dropped by a full $5. Their goal is to always be the first retailer to lower prices and the last to raise them, constantly widening their competitive moat. This high-volume, low-margin approach generates a ridiculous amount of operating cash flow. And that massive influx of cash effortlessly funds a staggering $6.5 billion annual capital expenditure budget. That money flows straight into funding those new high-density urban builds we talked about, rolling out digital upgrades, and expanding their global depot networks. It fuels the next cycle of growth without ever compromising their core financial strategy. So we really have to ask ourselves, as the line between traditional big box retail and high-density tech-enabled commerce blurs, what does the warehouse club of 2030 actually look like? With Costco evolving into an urban developer, a digital innovator with 8-second checkouts, and an unmatched pricing authority boasting 40 million power shoppers, how will competitors possibly adapt to a fully optimized, urbanized Costco? That is the strategic reality retail executives have to face. Thanks for joining me on this explainer, and definitely keep your eyes on how this whole strategy unfolds.